Hey everyone, this is Steve Elwell, Chief Investment Officer at Level Financial Advisors, and this is your third quarter 2025 market update. We had another great quarter for the stock market, both in the U.S. and outside the U.S., and the bond market also had a great quarter. U.S. stocks were up 8.18% for the quarter. International developed stocks were up 5.33%. Emerging markets rallied very strongly, up 10.64%. And global real estate also went up at 4.22% for the quarter. The bond market actually experienced a 2.03% increase for the quarter, which actually is a wonderful quarter for bonds. And the overall market sentiment at the moment is quite positive with great momentum. There's actually a lot going on in terms of artificial intelligence and the capital expenditures around building out the infrastructure needed to support the amount of technology and electricity that's going to be needed to support all of the artificial intelligence that's hoping to be implemented not just with the world's largest tech companies, but also sort of work its way down to everyday businesses and small businesses that may be able to implement some of that technology to become more productive over the next few years. So we're going to talk a little bit about that in a second, but first I want to touch in on specifically the bond market, which I mentioned was up 2.03% for the quarter. The U.S. aggregate bond market, which is really just kind of what people refer to as the overall U.S. bond market, is now up 6.13% through the end of September. That's on pace for over an 8% year for bonds. 8% is a stock market-like return for a calendar year, for a 12-month time frame. So the bond market is doing very, very well as interest rates continue to creep their way down. Specifically, we had a bit of a change in terms of the interest rates that the Federal Reserve sets. In September, it was widely expected that we were going to get an interest rate cut, and that's exactly what ended up happening. And it seems like we might be in a new stage of Federal Reserve policy where slight interest rate cuts over the next year and a half seem quite likely. The reason I believe that is because that's what they're telling us, which is pretty straightforward. Now, you know, the Federal Reserve is a group of governors who sit in a room and talk about what is happening in the economy and the job market and with inflation, and they make a decision about, you know, should we keep rates where they are, or should we lower them, or should we increase them? As a reminder, they have a dual mandate. So they are supposed to keep inflation low. Low in their mind is around 2%. That's their target. Inflation's a little bit higher than that right now, running around 2.5% to 2.8% for the last 12 months. So a little higher than what they want, but they think it's going to keep creeping down. And then to keep the labor market fully employed. And in their mind, fully employed is like 4%, 5% unemployment. That's what they would consider full employment for the U.S. economy. And we're right in that range. So that is good. So what we're showing on this visual here, though, it's a chart we've showed many times before because it's the best way to really think about the federal funds rate, which is essentially the interest rate that the Federal Reserve Board sets. And this gray line here on the right side shows the most recent decrease, that slight notch down that's happening right now, that 4.13% in gray. That's a slight notch down from where it was before they cut in September. But more importantly, what I want to talk about is the blue lines here, the blue dot points, and then that purple point. And those stand for the Federal Open Market Committee, which is what everybody just calls the Federal Reserve. It's their future expectations and estimates of where the federal funds rate will be in 2025 and 2026, and then the purple number is the long run number. So the first thing they're telling us is right now, the federal funds rate is about 4.13. They have right now they're kind of have it between a range of 4 to 4.25, so that's why they list it here as 4.13, because that's kind of the middle point of that. But the purple dot is saying that their long-term projection a few years out is for interest rates to be set at 3%. And it doesn't take a genius to say, well, we're at 4.13 right now, and if you're trying to go to 3%, then you're going to have to cut about 5 times, 0.25% cuts. Usually they move 0.25% at a time, and that's what they did in September. So 5 cuts between now and where they think the long-run projection is. Now, the long-run projection is no guarantee. That's just what they think will happen if everything kind of stays as it is. But that's not how the world works. That's not how economies work. That's not how the investment markets work. That's not how inflation works. We get surprises. We have a dynamic economy, so we have changes that happen all the time. Hopefully they're good, but sometimes they're not. There can be unexpected geopolitical headwinds, legislative headwinds. I mean, right now, we're facing a government shutdown. That's not something that the Federal Reserve generally expects to happen or expects to have last for a long period of time. So there are always moving parts, but their projection is an interesting one because it kind of tells you what they're trying to get to if all things go right or all things keep going as they are. So that's a useful piece of information because if that tells us that they might have another cut this year based on this dot plot, these blue dot plots. So we might get another cut in December. We'll probably get several cuts in 2025 if everything goes according to plan. And maybe even a few right in the beginning of 2026. We'll see how fast they move. And how fast they move will depend on the information they get, right? If inflation keeps working its way down to 2%, then I think they'll be more inclined to keep cutting sooner. If the job market stays with low unemployment, then I would expect that they'll keep, moving. Well, at that point, they'll move probably slowly if things are looking okay on that front. But if job losses start to accumulate, or the pace of hiring starts to dramatically slow on these monthly job reports, then you may see them start to cut faster to try and support the economy. So time will tell, but the reason I'm really showing this is I think this is and should be at the moment considered a tailwind for the fixed income portion of the portfolio. And it's part of the reason for what's already happened with interest rate cuts, is part of the reason why the bond market has done so well this year. Is, as a reminder, when interest rates go down, generally bond values go up. And how much they go up by depends on how long-term is the bond. If the fixed income or bond is relatively short-term, like 1 or 2 years, then it may not go up by very much if interest rates are cut. If the bonds are longer term, like 10 years or 20 years, then they might go up a lot if interest rates are cut. And that also works in reverse. That's part of the reason why 2022 was so bad for both the stock market and the bond market, is because interest rates were dramatically increased from essentially 0 to 5%, over 5%. And that was a huge negative for bond holdings. And you may say, why is that relationship like that? And it's kind of purely a mathematical one, which is nice from the investment perspective because it's kind of easy to understand. And the simplest example I can give, and some clients probably have already heard me say this before, if you went to buy a 1-year bond in the market, and let's say the interest rate was 4%, and then the day after you buy it, they cut interest rates to 3%. Now everybody wants to buy your bond because yours is paying 4, and if they go buy a new one, it's only going to pay 3. So then they say, someone trying to buy your bond would say, I'll pay extra to buy your bond. I will pay a higher price to buy your bond because I'm going to get 4% interest rate instead of 3. Now, how high of a price? Enough to make the interest rate or the return over the next 1 year essentially equal to 3%. And mathematically, that's, for the most part, there are other factors, just to be clear, but for the most part, that's how bond investors will calculate how to price a bond based on what the actual bond's interest rate is when it was first created and what the current interest rates are and how they compare. So in essence, it always ends up trying to equal out the return to match what current interest rates are for whatever the remaining term of that bond is. But the end result is, and the way to think about it is, when interest rates go down, if you have already owned bonds that have higher rates, people will want to buy them and they will pay a higher price for them. If interest rates go up, that makes the bonds that you currently own less attractive because those rates are lower than the new rates. And so if you want to sell it, you're going to have to take a discount. Generally, if you're buying a bond and you just hold it to maturity, you don't even really have to worry about any of those things because you'll get your stated return from when you first bought it as long as the bond is repaid. Just want to clarify sort of how bond prices move relative to interest rates and what that relationship looks like. And we wanted to show this visual because it's a really interesting one that I think is important as we think about how bonds might perform over the next 1 or 2 years. This is definitely not a guarantee in any way at all about what will happen in the bond market because there are other factors, but this is a major factor that if we're sitting here a year from now and interest rates are 0.75% lower, my baseline expectation is that bonds had a great year. And there will be other factors, but baseline expectation will be things are going to look pretty good if they keep cutting interest rates for the bond market. So that's one aspect. Second aspect is get a lot of questions about how is it that the stock market is continuing to reach new highs all over the place. Big U.S. stocks, international stocks hitting new all-time highs and pushing higher. We're 3 years into fantastic investment markets. If you go back to the bottom of the last downturn, which was fall of 2022, it's really been an incredible run. The first part of that 3-year run was really just a recovery from the downturn that happened in 2022, which isn't that long ago, right? But it's pretty quick to forget what that was like after having a couple of good years. So the first part of like 2023 and early 2024, I think, was a story about just recovering. And keep in mind, at that time, in fall of 2022 and early 2023, every economist out there was predicting a recession for the U.S. economy, global economy, and it didn't happen in the U.S. We never got it. It never showed up. Earnings ended up being better than expected. GDP growth was better than expected. And it turns out that even though we raised interest rates from 0 to over 5% to fight inflation, which worked, by the way, definitely worked. There's no question that worked. Inflation went from almost 9% down to 2.5%. But the U.S. economy survived that. Again, very dynamic, right? Businesses, business owners, CEOs, turns out not only are smart about trying to plan for the short term and the intermediate term, but are quite adaptive at trying to solve for things like inflation and supply chain issues and any other problems that pop up, as they should, as any good business owner should, is trying to solve the challenges that they face, no matter what those challenges are. But we keep getting the question sort of how is this stock market continuing to move higher? And the short answer is just that earnings continue to be better than expected. And obviously the more money that companies earn, the better, the easier the justification for a higher stock price. If you thought they were going to earn $1 billion this quarter and they ended up earning 1.2, you can make a very easy, simple case that the stock is now worth more, as a very simple, generic example. And some of what is out there is just sort of a question about, well, what is driving it though? Like, how is that? What's happening? Are people just like spending a ton of money? Is the U.S. Consumer over borrowing or something like that? And there really are no metrics telling us that. What there are metrics telling us are the next two charts that I'm going to show you right now, which is number one, that the investment in artificial intelligence, the capital expenditures, which is just businesses taking some of their free cash flow and reinvesting it in the business for whatever, in this case specifically to build out the infrastructure to help them become major artificial intelligence players. So this chart on the left is showing in billions how much Alphabet, which is really just Google, Amazon, Meta, which is Facebook, Microsoft, and Oracle, just these five, only these five, are spending on artificial intelligence investments. So it tells us in 2024 they spent around $211 billion of capital investment in artificial intelligence. The projection for 2025 is now $347 billion just for these five. That's expected to grow to 422 in 2026 and 467 in 2027. Going back to what they spent last year, compared to this year, that's like over a 50% increase. And it already had almost doubled from 2023 to 2024. The amount of money that's being spent to expand the availability of using artificial intelligence for these major tech companies, which, keep in mind, are like the world's largest companies. They represent almost 40%. If you add like the top 10 companies in the S&P 500, represent like 40% of the S&P 500's market cap. Just 10 companies out of 500 represent 40% of the weighting. And they're spending an enormous amount of money building out their artificial intelligence infrastructure. So that's data centers, that's cooling units, that's chips, that's computers, that's servers, that's electricity, that's all the above. So there's a major amount of business investment that's happening right now. And some people might be concerned about, oh, okay, well, what if that doesn't pay off? Well, what is the payoff? So first, let's look at the chart, the other chart on this page on the right, which is U.S. industrial production of high-tech industries since 2020. Each line represents sort of a different category. Computer equipment is blue, communication equipment is purple, semiconductors is like a dark blue, and all other industry X high tech is green. You can see that they smartly, JP Morgan smartly put a line on here when ChatGPT was launched, which was really the first major language learning model, which is what people kind of say the engine ends up being of artificial intelligence, was released from OpenAI. You can see all other industries, the industrial production is somewhat flat since that happened, and even since 2020 is somewhat flat. But if you look at computer equipment, communication equipment, and semiconductors, absolutely through the roof since ChatGPT was launched. And behind the scenes, what is happening is these companies ultimately are buying all of this stuff, all of this technology, equipment, to try and be major players in what they think will become a transformative technology for businesses across the world. And they want to be the leaders that help provide that engine to grow the ability to have all these software companies come out with artificial intelligence tools that everyday businesses can use. So let's show some of that on this second chart, which is, well, okay, if we go invest all this business money, all this free cash flow from the world's largest technology companies to build out all this infrastructure to house our artificial intelligence data centers that are going to power all of this. So first we build the engine with the nuts and the bolts and the wheels and the steering wheel. And now what do we do with it, right? What do we do with this technology that we now have that's quite a bit more powerful than what we used to have? And on the left is first a visual of U.S. labor productivity growth. So the growth rate, the trailing 10-year average growth rate through 2024. And most notably, they've put a dotted line on here for the personal computer, which was invented in 1981. But more specifically, as you look at the productivity growth of the 90s, you see this upward movement from the 90s to the early 2000s as computers worked their way into the office landscape and everyday businesses started to use them. They became quite a bit more productive. Their growth rates in terms of productivity, their rolling 10-year growth rates spiked from where they started when the computer was invented, which was around 1% per year, got all the way as high as 3% per year. And you may say, so what? I mean, 1 to 3%, what difference does that make? Well, hold on a second. You have to multiply that by millions of businesses and hundreds of millions of workers. 1 to 3% is a gargantuan move. That is an enormous amount of extra productivity from the same group of employees and businesses just by utilizing a new tool. And the hope is, the far right side of that chart is that we're going to start getting another bounce like that in productivity. Now, how big will that productivity bounce be? I don't know. Nobody else does either. The hope is it's quite a bit. And so far, it looks like it probably will be. There will be something. But I don't know how big it'll be. Nobody else does. But that's where the optimism is coming from. That's where the optimism, and you hear it from the businesses, the corporations on their quarterly calls. You hear how they're starting to slowly implement. I mean, I think of a company like Walmart, and this is not, to be clear, a stock recommendation. But I think about a company like Walmart, which is not a technology company, but obviously uses a lot of technology. And if Walmart thinks they can get 1% per year more productive based on their size, that would be an enormous move. That would be a huge, huge move. So I think the optimism in the stock market is coming from, a lot of it is coming from, number one, earnings are just simply better than what they thought they were going to be. But number two, the optimism about future productivity gains that may result in even better earnings without huge capital expenditures of having to hire 20% more people. Now, there is a fear that some jobs may be replaced by artificial intelligence, and any new technology that sort of has implemented its way into the U.S. economy or any other economy has challenges that come with that, and we'll have to see how that gets solved, or how the economy adapts, or how the labor workforce adapts. So those are real concerns. But when you ask how is it that the stock market has hit new all-time highs and had such a good 3-year run, that's the story. Stocks have rebounded from 2022 and then moved even higher based on real earnings growth, and moved higher based on optimism about future productivity gains from implementing artificial intelligence. And even this chart on the right side here that we didn't cover is showing the percentage of businesses that expect to use AI to help produce their goods and services. And those are all increasing over the last 2 years. Many of them have doubled over the last 2 years, and expect to continue having notable increases over the next 6 months. So time will tell as to how is it that things unfold, how much more productive do businesses get from utilizing AI tools, what AI tools get developed. But the general gist is that the underlying current of the economy is being majorly supported by business expenditures in artificial intelligence infrastructure and building out artificial intelligence infrastructure. And the second leg of that is how do everyday businesses, non-technology companies, end up using those new tools to get a little bit more productive. And we're all going to find out, but that's where some of the optimism comes from, coupled with the actual results already looking better than expected. So hopefully that wasn't too long-winded of an explanation about some of the things that are happening, under the hood of the U.S. economy. But it is a very interesting, that's the old saying, right? May we all live in interesting times. And I think at least from like a market observer standpoint, there's no question the last 12 months and the next 24 months will be very interesting times as we're going to see what the real impact is of the creation of some of these artificial intelligence tools and then the implementation of some of those tools and what effect do they end up having on everyday businesses and large publicly traded businesses. And we're all going to find out. So with that, I'm Steve Elwell, Chief Investment Officer, Level Financial Advisors, and I look forward to talking to you next quarter.